George from, I'm going to mess up the abbreviation.
UHY.
UHY, okay. I was going to get it right the first time. And Eli from Betterment. And I think we'll just take 2 seconds to just sort of introduce ourselves and what we do day to day. As an investor, I deal with valuation all the time. I try and get in at the best possible valuation, and entrepreneurs try and sell their shares at the highest possible valuation. Hopefully we sometimes try and meet somewhere in the middle. But it's a question that comes up in my day-to-day along the fundraising route all the time.
Okay, my name is George Crane. I'm with UHY. UHY is a accounting firm, so we do tax, audit, and consulting services. Within that bucket of consulting services, we do valuations for a whole slew of purposes, including for valuing startups, could be for mergers and acquisitions, estate and gift tax planning. There's a lot of different reasons that require the value of a company. As far as myself, I've been doing valuations for about 25 plus years across a broad spectrum of purposes, and I'm happy to be here to address the valuation issue with respect to early stage companies.
My name is Eli Brofferman. I'm a co-founder of Betterment. We are an automated investment service. We give advice, financial advice about goals that you should be saving for in your life, and use technology to intelligently manage investment portfolios towards reaching those goals. We make the experience painless and do it for really low cost. And Betterment has been live for just over 4 years, and we've done 3 venture rounds in the course of our history. I've been directly involved in all 3 of those rounds, so I have experience as an entrepreneur on that side of the table. And my day-to-day job, when we haven't been raising money, has changed a lot over time. If you asked me a few years ago, I would have said I'm deep in the weeds of building a product and the technology and thinking about our operations. And nowadays, I spend a lot more of my time on thinking about how to grow a team from 50 to 60 employees to 100 or so.
Eli, I have the first question I want to bring up related to, you've gone through 3 rounds. How has the valuation conversation changed across those rounds, and based on the progress you made? I mean, were you guys, and maybe it had to do with also cycles and timing, were you guys makers of the valuation or takers, and did that change in each round?
The biggest change is between the first round and the A round. We didn't do a seed round, which is becoming more and more common now.
So you had no friends and family?
We bootstrapped.
Okay.
And went from that, launched, and then did a full A round. We can come back and talk about some of that history later. But when we did that, there was no anchor. I think there's a lot of talk about. It's interesting, of course. The title here is Science Evaluation, but more commonly it's thought of as an art. And when there's no anchor whatsoever, it did feel a little bit like you were pulling out of thin air.
So no anchor in terms of you hadn't done a previous round, so you didn't know where to set it.
Exactly. So in all the subsequent rounds, we did an A round, we had a certain price at it, a couple years went by, we had a certain amount of growth in the number of customers, and we measure things by assets we're managing, whatever the metrics are, and we can relate that back to what the price was in the last round and measure some progress. The A rounds, I don't know. What do you think? And we came in, and our experience has always been that investors have asked us, what are we looking for? What do we think is the right price? So we had to come up with it.
So were you afraid of bidding against yourself in that? Like, how do you know the investor's not sitting there going, okay, I'm willing to pay 10, and you're sitting there going, I think this guy's thinking 2, I'll just say 6, and then you kind of mess it up. Did you actually say a number to them?
Yep. It's a scary thing. You don't want to bid against yourself, and you don't want to scare away an investor. And you really have to strike a balance. And I think we were concerned on both sides. You can really imagine that if you come out of the gates and you say, well, we think the company is worth $30 million, and the investor says you've got about 100 customers that they're gonna balk and think you're crazy. I think what's important in this situation is that you have conviction. So research, understand what's going on in the market, what like companies might be getting at least some range, and feel like you're coming at it from a reasonable standpoint, and try to start with a range instead of just saying a number, or say, well, we're thinking high single digits. There's a language to negotiating a deal. So high single digits, or maybe it's north of 5, and it's certainly we're not looking for more than 15. Investors get the point.
And do you think that anybody would ask the pricing question if they didn't already have some interest in the company? Was that part of the first conversation, or was that a couple of conversations in, they wanted to see like where this might play out? Like, why do you think they're asking?
Sometimes they're not interested. I think sometimes investors are just curious folks.
Mm-hmm.
So it certainly depends, but hopefully they're asking, they're interested. Usually that's the case. But I don't know. You know your business better than investors know your business, and nobody wants to waste time. And sometimes investors, they're going to need to do much more diligence before they can sort of deduce what an appropriate number is. And so it's efficient to have the entrepreneurs start by throwing out the first number.
And what were your sensitivities in that first round? Like, how much do you think about what you're setting yourself up for future rounds? Do you think about dilution in your own ownership? Are you just trying to get a certain amount of money and you just need $5 million to take over the world and you'll get it at any price? Like, what was important to you in the first round?
All of it.
Getting money at all?
Right, but I think you want to know what's most important. I do think what's most important is you have a vision for what you're going to do with this capital. It's obviously important to investors themselves. It's one of the most fundamental questions. What are you going to do with this money that I give you? But you need to know as an entrepreneur, where is this money going to get me to? Is it going to get me to an exit? Is it going to get me to the next round of funding? What's the runway look like? And that should be what you focus your goals around. I really do think you want to optimize around price. There's lots of other important considerations. We can talk about what other value investors bring to the table, but this is venture capital. You're raising capital. You want to do it at a good price because if it's early in a company's history, there's going to be more dilution. You want to make sure that you look for that and still make it so that the outcomes are meaningful for the founders, for the management, for all the employees.
So George, there's this interesting process. So now we've gone through, we've had a little price negotiation with our investors, we closed our deal, and then there's this interesting second step where the investors get together and they say, great, now we have to value the company like all over again, and we have this 409A thing that somebody's asking me to do, and they're asking me to set the price for options. There's like 3 or 4 other little esoteric numbers that we have to come up with after we just agreed with investors what we thought the price of the company is. So can you shed some light on some of that stuff?
Sure. Well, I mean, first of all, when you're talking about a startup company, you're talking about a moving target, a fastly moving target. So the price that's in effect, a couple of months ago, the company's hit some milestones or made some progress or not made progress, the value is going to fluctuate dramatically. And so that's one reason that drives the need for evaluation over relatively short periods of time. I would like to circle back and just make a comment and reiterate what Eli said. The topic of this conversation is the science of valuation. 100% agree with what Eli said. There are some techniques, there are some methods, but it's largely an art. And there's no two ways of getting around that. And it's sort of misleading to say that whatever your models spit out as far as a common stock value or even a preferred stock value, that was scientifically derived. There are so many inputs that go into those models. It's highly subjective, highly speculative. The company themselves, like I mentioned, is a moving target, so things change dynamically over short periods of time. So I just want to get that off the top, is that when we talk about the valuation aspect of an early stage company, it's largely art. And you know, there are techniques and things like that, but you have to realize that at the get-go. So what was your question?
So after we've agreed on what price we're going to sell shares to investors, that's not the only valuation question that happens. For example, with options and for tax purposes, there's a couple of other things. The valuation calculation doesn't stop with, you know, we're investing $2 million on a pre-money of 8. Then after you go through your first board meeting, somebody says, well, what's our 409A valuation? What's our strike price on options? And we just went through this painful negotiation with investors trying to figure out how much we're worth, and this is like completely other things that I've never heard of.
Right. So when a company gives stock options to employees as an incentive to have them, participate in the growth of the company, they are accepting a non-cash consideration, and for tax purposes, that stock has to be valued. And for tax purposes, there has to be some rigor to that valuation. You just can't say, well, you know, it's some rule of thumb or whatever. There has to be a thorough analysis. Now, it may be subjective and it may have a lot of input, but it has to be reasoned. And so for tax purposes, that's the 409A purpose. The IRS will be looking very closely at what the value and the exercise price of those stock options are going to be because for their tax purposes. For financial reporting purposes, there's a code section, it's called Accounting Standards Code 820, which governs how fair value is determined. I should point out one thing. For tax purposes, there's this concept of fair market value, and for financial reporting purposes, there's this concept of fair value. For all intents and purposes, it's a difference in semantics. They basically mean the same thing. What would a willing buyer, willing seller pay for the property that is being subject to a transaction? So, in any event, for IRS 409A purposes and for financial reporting purposes, a valuation is required. And that has ramifications for the company when they think about whether they're going to grant options. They may need unless they do it themselves, they may need an independent appraisal from an experienced firm that does these 409A valuations or these ASC 820 type valuations, which are very complex.
And what are we trying to accomplish there? Are we trying to give our employees the best deal possible? I mean, why don't we just say, well, you know, it's a startup, it's not really worth anything yet, so, you know, hey, it's worth a penny.
Well, the company is trying to accomplish that. They want to incentivize the employees by granting stock options, and that's fine. But as far as the value of those stock options are concerned, that has a tax ramification, it has a financial reporting ramification, and it has to reflect fair market value.
So the IRS isn't going to support my penny argument?
They may not.
Okay.
In fact, they probably will not. They want to see a detailed analysis embodied in a report that has, a lot of thought process going into it.
To go back to the options, and when you think about sharing the growth and the upside with employees of your company, that's also a value conversation too, because you guys as founders, you've already sold a piece of your company to investors to get capital. Now you have to get employees on board. Obviously, they want as much of the company as possible. You want to give up as little as the company as possible. How do you as a founder think about what a potential employee is worth, how much value you're trying to give to them, and when you set out, how much of the company did you imagine would wind up in the hands of your employees? What were some of the typical deals you might strike with early employees versus later employees?
So you want to start from a place of recognizing that equity is a precious resource. You want to be careful with how you dole it out. My belief is you within that framework, you want to be generous to employees at any stage, whether it's early or later, where you really believe in them. Talent, acquiring good talent is, in my experience, been the most important driver of growth and success. So you want to reward that, and you want people to be invested in your company. I was reading there's an old shareholders letter that Jeff Bezos wrote in 1997 to Amazon shareholders, and he talks about being generous with equity to employees and wanting them to feel like owners. That's what you're trying to achieve when you give out equity to employees, and the right amount changes over time, but you want people to feel like they're really well rewarded with equity, and that they're going to be with you for a long time. And you just think about the fact that you put people on a vesting schedule, so if it's not working out, people move to a different opportunity, they're not going to walk away with something unfair or disproportionate, so you use those tools in the right way. You had some other aspects.
Well, actually, one thing that I also want to bring up before we skipped over, because we went right to employees, is you have a co-founder. Yep. And I don't know if you came to the business right at the very same time, if you sort of split things up right down the middle, but a lot of the folks in the audience might be thinking, well, I have an idea, I might need a co-founder who has a complementary skill set, maybe I'm the tech person, I need a business person, or the other way around. How does equity play into the conversation and value the person versus the idea versus some role that's really important? You know, did you guys have to go through like difficult conversations at first to figure out, like, when you did the very beginning, like,
yeah,
how much were you worth versus somebody else, a co-founder?
Yeah, sure, it was difficult. It was relatively amicable. I actually, when Betterment started, there were 3 original co-founders, and we didn't actually settle equity right away. We sort of.
So you started working right away.
It wasn't full time, but we probably spent 6 months. Now, I didn't know my other co-founders, so there was some level of trust that we would figure this out. But we probably spent 6 months before we finally came down to figuring out how we're going to divide things up. And at that point, I think there had been a clear level of seniority that had arisen. So that actually helped us for our benefit. My co-founder, John Stein, who's our CEO, it really was Betterment, what really was his idea. And as we worked more and more, he was the one that was driving the vision. So it made sense. Everybody understood that John was going to get a little bit more than myself and Sean, our other co-founder. But we had some difficult conversations about it, and there was, I wanted more, and John wanted more. There was a little back and forth. Everybody got to a pretty good place. I'll say one other thing that was important about what we did early on, which was that we game planned for what would happen if somebody left. We had some vesting terms in there, and we had very clear terms about what would happen if somebody decided to leave early on or maybe a little bit later. And that ended up happening. John and I have stayed with the company, but Sean had a different opportunity and ended up moving overseas, and we never had to fight about it. We never had to go back and forth. We just looked at the agreement and said, this is what happens, and everybody was happy about it.
So the whole plan of working together for 6 months without having an agreement, when you guys go public and exit Betterment for a ton of money and you become an angel investor, is that going to be your going forward advice to companies? It's like, yeah, just work together for 6 months. Don't worry about the equity, and you'll figure it out eventually.
No, no. Actually, I feel really lucky. I mean, there were points where I worried that it was going to get ugly. That boy, we've invested, we've dug in, we've all spent a few months working on this, and is everybody going to be reasonable about it? And so I stressed about it. I wouldn't really recommend it. But I've had a lot of conversations with entrepreneurs that have said that they've ended up settling on equity once, and then roles change, responsibilities change, and they have to go back and rejigger. So I don't think what we did was so uncommon.
What was uncommon maybe is you had a pretty smooth experience and you trusted your partners and everything kind of worked out. But Charles, there was a talk from Northside a couple of months ago Charles Lowenstein from, Charles Torres from Lowenstein, Sandler, he made a big point about getting these issues about equity ownership worked out sooner rather than later, even no matter how difficult they are, because, like you said, roles change, things change in a dynamic environment, and feelings can get kind of frayed, and it just gets harder the more you put that off.
One thing I'll sort of throw in as an investor, this point about some founders not staying with a company happens all the time, especially in this world of like accelerators and school programs and startup weekends, and startups seem really fun until everybody's asked to quit their job and go full time, and then you inevitably a lot of times wind up losing people. And I think one way that I advise companies to think about it is how much value has been created in the company up until now compared to how much value you will create over the next 5 to 7 years, right? And it's just very hard to make the argument that, 7 years from now, when we're a $500 million exit, how much of that have we accomplished yet? That you really get to much more than like 5% of that. And so if you say, okay, well, if we were 4 equal co-founders, and we think this company is like a 7-year trip, and we were working on it for 3 months over Techstars, you could divide that equity 4 ways if you wanted to, but then you're dividing it amongst how much progress has been made up until this point, and it's really not that much. So, sometimes somebody who was early on in the beginning and made a meaningful contribution, you might give them a couple of %, but I think it's often really problematic for investors and future employees when you see that somebody who's not making a significant contribution owns 25% of the company, and that's the debt equity basically out there.
Yeah, I'd echo that. I want to reward employees or other team members, but you want to save that equity for the people who are going to be there for the long term. I hate to see situations where people who maybe did some part-time work for a while, or got a few points for a short-term consulting gig. That's not where I would want to spend my equity. I would want to spend my equity on people who I actually think are going to be there from the start until years down the road.
George, on the structuring side and tax side, I know it's hard to sort of think about potential exit early on and the money I could make from this company, but there are other kinds of companies that are, maybe cash flow generative companies that maybe might not want to take investment. What are some of the tax considerations that might go on early on when I think about not just the value of what this company might be worth, but the value of how much money we can make over the course of the future? When you take on a client and they're asking you about structuring and tax consideration, what are some of the questions you ask them early on?
Well, I'm not a tax expert, but we have tax capability in our firm. The general answer to that question is that they get asked, our tax guys get asked questions like, how should we structure the firm? Should it be a LLC? Should it be an S Corp? Should it be a C Corp? What's the best strategy? And I think the answer is that, well, what is your long-term plan? So if you're planning to do an IPO as the most viable exit strategy, then it might behoove the company to think in terms of a C Corp, especially if you're not going to be earning profits over a relatively short period of time. Then you don't have to worry so much about paying taxes either. But what you as a C Corp, then when that IPO takes place, you don't have to recreate the financials, and so if an IPO is not in the likely planning for an exit, then and the company's cash flow positive and things like that, well, then maybe you want to be a pass-through entity to shield as much income from taxes as possible. As far as further nuances, I would have to defer to our tax guys, but that's the general flavor of it.
Gotcha. Going back to the entrepreneurial side, you guys obviously have bigger goals, and there's conversations that you will probably have. Maybe they're brought on by an investor, and they'll ask, well, how much money do you need? And there's a trade-off there, because there's probably an amount of money you could raise right now that would put you in a really great position, but you'd have to give up a lot of the company based on your progress. And so how do you guys balance, do you actually sit down and do a calculation of like, well, if we have 30 million bucks, our equity might be worth this in the future. If we only took 10, we wouldn't have to give up that much of the company now. Is that, do you actually do a calculation, or is it driven by what somebody's offering you?
I've done it. I've had some spreadsheets. I've never actually found it tremendously useful. Because at the end, it's always kind of come back to what I mentioned earlier, which is you want to have a roadmap for what you're going to do with the capital, how much you're going to need to get there. And I've looked at it and I've said, well, we could sell 10% less right now and preserve some of that for later. We've tended to err on the side of take a little more capital, have a little more flexibility, take a little fundraising risk out of the equation, and I think that's been beneficial to us. There's just too many moving parts. What is 6 months more of runway get me? What does 5% less dilution get me? And too many different ways it can play out. Well, then, if I take more money now, then the next round will maybe be at a higher price, so that'll save me. If I take less money, then the next round will be at a lower price, so it's going to cost me down the road. I think you want to look at it more as what does this mean for the next 1 year, 2 years, whatever the roadmap is. How is this going to allow me to grow the team? How is this going to allow me to attract talent and bring in new employees who are going to feel like the company is in a stable place, is in a position to grow and succeed?
I would just add to that this is where the art of negotiation comes in, okay? So you have a good idea as the hands-on guy managing the business and having a good vision about where it's going. But what will help in the negotiation process is a detailed business plan that is a living document that's adjusted for reaching milestones and for other things that occur over time. And also, periodically, if the company does issue options, for instance, to employees, they need to have a valuation done. So if you have between a thorough, compelling business plan and perhaps a independent valuation, this helps your negotiation posture when you go before, in later stages, before a VC, sophisticated investor to get the best price.
I'll add in from the investment side. I think there's a sort of running joke about the sort of hockey stick chart that everybody needs, and I think a lot of entrepreneurs are sort of quick to dismiss that exercise, saying, well, yeah, everybody says they're going to make $20 million in year 3, and it's not about coming up with that end result. It's sort of how you got there. If any of you come from the finance world and gone through those investment banker, interview questions, and they say, well, how many pennies does it take to stack to the Empire State Building? Like, they don't really even know the right answer, and it doesn't even matter. It's the process of like your thinking and how you got there. So you very well might have the possibility of generating $20 million of revenue in your 3rd year, but just show me the backup. Show me what the dependencies are. Is that a function of raising $20 million? Is that a function of having 100 salespeople, in which case I don't think you might be the world's greatest recruiter, so you might not be able to get 100 salespeople between now and then. So I think that financial plan is a really good exercise to figure out like how you're getting there versus always ending up with the sort of hockey stick.
Charlie, as the VC, I'm curious on the panel. I'm curious, what's important to you when you're doing a deal? Is it price and the size of the check you're gonna write? Ultimately, you prefer to write a smaller check than a larger check, or is it more about getting to a certain percentage ownership in a company?
I think the one and only criteria I have is I have to think ahead and say, 4 or 5 years from now, am I going to be on a panel with this company, and is it going to be a constant reminder that I passed on this company 4 or 5 years ago, and it is going to feel, how painful is it going to feel that I missed out on the opportunity to invest in Betterment? So that's, which is actually true, by the way. So I will take full responsibility for missing out on that opportunity. But there are lots of companies that it happens all the time, and for New York's sake, I always tell a company if I turn them down, like, I hope you become really big, like, and I hope you totally, just don't prove me wrong. So congrats on making me feel foolish about not,
Thanks.
about not getting there. But I think it's a couple of things. I think what often surprises people is how a lot of people ask me, well, why do you invest? Like, what makes a company appear like the top 1 or 2%? And for me, a lot of it is about not being the 95% worst things. And there are surprisingly some really basic things that cause a company to sort of fall down in a meeting or during a pitch. I always feel like if I take a meeting with you, the investment is yours to lose. Because if I know I'm not going to get there on this company, I'm not going to take a meeting. I'm not in the business of giving you pitch practice, unless it's a pitch practice event. But certainly if you come to my office, it's not. And so I'm hoping that you have the world's most amazing company. And too often it's really basic stuff related to, for example, valuation is a consideration, right? And it's not so much that I want a big ownership percentage. In fact, as a seed fund, I don't really care that much about ownership percentage because I'm not following on in subsequent rounds. So I kind of feel like if I get in early and we're in the ballpark of single-digit valuations somewhere, which most seed deals are, when you exit, I'm going to do fine. I'm not worried about, and not every VC is like that, and some people want to get a certain ownership percentage. But sometimes it's a signal on behalf of the entrepreneur, where if you're saying, well, we're going to raise at this dollar amount, and it's way out of market. Like, it's really clear that you haven't talked to any other entrepreneur in the market, that you have a really outsized expectation of valuation. Is that a signal that you think you've accomplished way more than you've actually accomplished at this point? Are you setting yourself up poorly for the next round, where even if you do raise, and your post-money valuation is 12, 13, 14, I'll tell companies, like, you better do something amazing between now and the next round, because when there is an anchoring effect. I mean, you brought that up, where a Series A fund comes along and says, oh, your post on the last round is like 20. That's kind of where we thought we would do this round. And people sort of hate doing flat rounds. It feels kind of like demoralizing, and so it makes it seem like the company has sort of maybe mismanaged that process. I think the other thing is the amount of money you need realistic to hit your goals? And oftentimes I'll tell a company, like, okay, maybe it's not possible that you can raise more, so maybe they should actually do less. Or instead of saying, well, we're going to raise $1 million to do 5 things, it's like, if there are 2 things or 1 thing you got right, would that be enough to sort of get to that next round? So is your plan realistic? I think that's an important consideration too.
How often do you start talking to a company about a certain size round, and the size of the round goes up a little bit by the time you actually close it? Maybe it's different if you're doing earlier stage, but I'll share that that's happened to us with all 3 of our fundraising.
They got bigger.
They got bigger as the negotiations. That's obviously part of that's math. We want a certain price, and maybe the firm wants to own a certain amount, and that's how you can get everybody happy. Part of it was maybe, frankly, a little bit strategy. If you set it a little bit lower, set the bar someplace where we're going to be in a position to succeed and raise the amount that we set out to succeed, and then let investors maybe suggest doing a little bit more.
Sometimes the fundraising process feels like the last 2 minutes of a basketball game, where it should only take 2 minutes, but it doesn't because everybody keeps calling timeout and trying to get one more shot in or whatever. Where I've seen instances where it took forever to get the first 750K of $1 million round, and then we finally get it, and then it seems like everyone who said no or like didn't respond to us, right? I might be the first yes. And then we're like right about to close, and then some other investor is like, "Oh, you're almost done. Wait, don't why don't you take another 100K or another 50K?" And it just becomes this like, we raise. When you ever hear of a seed stage company raising like 1.2, like that probably means they aimed to take one, and when they got to one, everybody had remorse, and so they tried to stuff their way into the round at the end. So a lot of times the rounds get a little bigger. Sometimes it's a function of maybe the company goes out fundraising too early, and so they go out with modest expectations of trying to raise 750K. They haven't really, like, the riskiest thing that they'll do in the next 6 months is like so close, but they haven't done it yet. They won like one customer or got an install or launched. And so they go around, they spin their wheels, they try and raise that first 750, and like in the process of raising, they actually accomplish something. And now all of a sudden people come back and they realize like, well, actually now that we've accomplished that, maybe we have good traction. So they've been hanging out there for a while, but they've been still working on their company and moving forward.
I would just like to add, and you correct me if I'm wrong, because I'm a valuation guy, but not a venture capital guy, but I think what's important a lot of times in how deals take place, when money's available, is just the level of the market, if you will. In other words, if you were looking to get some venture capital financing in 2001, you would have taken any price. Yeah. But now, and over the past couple of years, it's actually been a pretty favorable environment for, there are investors out there, venture capital and otherwise, that are chasing deals and looking to invest, looking for great propositions. But that could change, and it could change overnight. And so you have to be cognizant of the level of the psychology of the market, if you will.
Oh, that's a key point, and I'll run one quick anecdote before we open it up to questions. In the last month, I've offered 2 term sheets on companies that we didn't wind up closing on because they wound up taking money from what I would consider to be less interesting sources of capital, where some really good investors, I think, offered sort of a fair opportunity, and they decided to go with the sort of highest price, which for a number of reasons I thought, wouldn't be the best value add to the company. And, wish those companies well, but at the same time, I think there's a lot of trade-offs, and a lot of VCs will tell you, like, yeah, we add a ton of value, and it really sort of depends. Like, I don't think anybody adds enough value, whereas, one VC comes in at a price of 10 and somebody else comes in at 5. Like, that's a lot of value they'd have to add to make that work. But if the difference is between like 5 and 6, and it's, Sequoia versus, Joe's Auto Body Shop and VC Fund, I think there's a real consideration that you have to go in there. Any questions from the audience about the topic? Sure.
How do you see the relationship between entrepreneurs and investors changing over the future years? Or do you see it changing?
Well, there's certainly more transparency in the market than there was before. I mean, when did you guys raise your first?
2010.
2010. That was probably pre-Angel List, or maybe right.
It was right at the very early days of Angel List.
I mean, it was never the case before that you could see who had just raised, what deals had been done, how much money had been raised. So it used to be sort of this black box, and I could say, well, this is the best deal you're going to get, and it was actually really hard unless you were going to go and like get 3 other bids or whatever. But now you literally know everybody who's fundraised in the past 2 weeks, and you can just talk to those founders and say, well, ballpark, tell me where that pricing is, you know, who they raised from and all that sort of stuff. So it's harder for VCs to be bad behaviors in the market. I don't think that you look at stuff like angelless syndicates and stuff, and something just came out that, like, Kevin Rhodes, who has like the biggest syndicate, like hasn't even used it yet. He was sort of doing it as an experiment, and a lot of the folks who were doing some of these syndicates are like busy off doing other things and thought it was an interesting experiment. Like, my job is not as hard as a job of an entrepreneur, but it is a full-time job of managing investors and trying to add value and all that sort of stuff. And I think a lot of new money comes into the market. There's a stat that says 70% of all of the money that an angel investor will put to work ever in their angel investing career, they do in year one. And the reason why is it's really exciting to write checks. And then when those companies come back and they say, we're not doing so well anymore, all of a sudden that 14th check, you're just like, oh, maybe I didn't know what I was doing. These deals sounded really good, right? And so over the long term, some of that new money that maybe isn't as experienced, savvy entrepreneurs say, well, I don't know if they might be giving me the right price, but are they full-time? Are they really working on this? What value are they going to add? So I don't think things will change as much over time. You guys have different perspectives on that.
So, found the hard data, it seems like there's in Series B and Series C rounds, both in terms of the amount of money as well as the valuation. My perception of this. Has there been a shift in what metrics people are looking at in terms of those valuations?
Not in my case. I can really best speak about the Betterment case. No, you know, people are looking at what's most critical for your company at the current time, and what are the most critical milestones or achievements over the next few years. It seems to me like it's a supply and demand situation where maybe there's more investor money that's piling into those stages. There's also been some talk about sort of a Series A crunch, and maybe that's on the flip side. That's a lot of companies that are getting funded by seed investors, by angel investors, by incubators. Now there's a lot more companies out there who are looking for that A round, and I don't know that there's necessarily more A round investors that are out there.
There's a really interesting article that Manu Kumar from K9 Ventures wrote about one change in the early stage market, and it's this whole concept of like seed and pre-seed, which is like this pre-seed. I'd never heard this term, but I've been in venture capital since like 2001. And what's going on is some of the seed funds are bigger, and so you see these things where, like, you know, we raised our $2.5 million seed round, and you're sort of scratching your head like, that doesn't really sound like a seed round. Well, like 10 years ago, that used to be an A round. And so I think there's a nomenclature change that people who consider themselves to be seed investors who write smaller checks are now able to write bigger and bigger checks. And so some of the things that we used to call seed look like a $2 million round on a $10 or $8 million valuation. Well, that doesn't feel very seed-like to me. And so there's room for something to come before that, like a 500K round, which used to be seed, now it's called pre-seed or whatever, friends and family or angel, or I've stopped trying to figure out what any of this stuff is. But one interesting point that he made was, like, he listed A rounds as $6 to $15 million. And so when I hear Series A crunch, like, yeah, the bar to get a $10 million round of investment is pretty high. And if you think of Series A rounds as like 3 to 5, and now they're 10, well then, yeah, there is a Series A crunch because the bar is higher. Obviously, you're going to have to do more to get 10 than you used to be able to do to get 3, but now you're getting some of those same amounts from different sources.
What do you see as like a ballpark ratio between price on preferred shares which are investor round versus
You know, you have to kind of refrain from, well, they don't work. Each situation is.
just ballpark?
All I can tell you is that preferred shares are going to be much more valuable than common shares. You throw whatever ratio you want to do in that. As far as tax purposes or financial reporting purposes, those rules of thumbs are not going to hold up.
I'm not trying to just about the IRS, I'm just curious.
Yeah.
It is
One third is, and I can only speak about my experience. So it might not hold true for any other company.
I mean, I used to hear 10%, but I don't know. It varies from situation to situation. You actually have to sit down and do a formal evaluation of the situation. That's my take.
It depends. Any other questions? How many, just out of curiosity, how many current entrepreneurs in the audience? How many people have raised money? How many people have raised money from someone who wasn't themselves or friends and family? How many people are currently raising? Okay. How many people think they might have gotten a bad deal on their valuation? Great, it's a really great environment apparently. Nobody's willing to admit it. One final point I'll sort of make about this is one thing that I generally, the point about having enough runway was made and taking a little extra. I started in venture in 2001, where all we did is like watch companies shut down, basically. Like venture was like no fun for like almost 2 years before we ever saw a positive returning quarter in venture. And then I started a company at the end of 2007 and went to go raise my A round in October of 2008. That really sucked. And no one was willing to write any, I mean, it was a joke. I mean, literally I was in San Francisco trying to pitch my deck the week that Lehman went under. So that didn't work out very well. And so I've been sort of traumatized by both of those experiences. And I always tell founders, I don't know of any founder that have ever exited a company for $100 million or more that wishes they took less money in their seed round. No matter what the dilution was or whatever, that generally if you get to an exit, it's usually a positive outcome for somebody. And then secondarily, the more you do up front, the more you have in control later, right? You start producing your own cash. You have the flexibility in later rounds to really affect how much dilution you wind up taking over time.
I'll add on back to the perspective of how to share equity with your team and your co-founders. I've never had anybody that I've worked with who's been really great, an employee or a co-founder, who I've ever looked back on and said, boy, we gave that person too much. I really wish we had just cut down the equity a little bit. I've always been glad that we stretched to make sure that we brought in the right talent.
I would just add, as far as the valuation is concerned, it's a central part of the equation. It may not be the most important, but it's very important. And I would urge you to, in that vein, to have a living document business plan updated all the time, adjusted, and also periodically, for your own planning purposes to see how you're on track with the exit, have a valuation by an independent party.
And you need to for option.
And you would need it for tax purposes or for financial reporting purposes, but just for your own purposes as benchmark. Periodically, it's good to know what an independent appraiser who does these 409A evaluations all the time, utilizing their sophisticated models, what is the value of the company.
Thank you guys for sharing this time. Appreciate it.
Thanks.
Cool.